Hi, it's the Tax Geek again with more of your taxes oversimplified. Today we answer the question, why is my Social Security taxable? Well, the short answer to that question is that Congress made it so. From the beginning of the Social Security system in the late 1930s until 1984, none of your Social Security benefits were taxable. However, in the early 1980s, the Social Security system was facing a funding crisis. Given the trends at the time, the Social Security Trust Fund would run out of money just as large numbers of people would be retiring. A direct payroll tax increase would have been very unpopular, so the Social Security Amendments of 1983 made rather sweeping changes to the Social Security system. As a result of these amendments, starting in 1984, a portion of Social Security benefits would become taxable for people with high incomes, with the proceeds going into the Social Security Trust Fund. At the outset, a maximum of 50% of a person's Social Security could be taxable. In the 1990s, this maximum would be increased to 85%. Whether you agree with the situation or not, taxation of Social Security benefits is here to stay. And more Social Security recipients are seeing their benefits taxed because the taxability thresholds, set in the mid-1980s and 1990s, remain the same to this day and have never been increased. The original taxability threshold for a single taxpayer was set at $25,000 in 1984. That's about $62,200 in today's money. So that being said, the question we really should be asking is, when does my Social Security benefits become taxable, and how is that amount determined? Social Security benefits start to become taxable when one-half of your Social Security benefits plus your additional income exceeds a base amount. This amount is $25,000 for taxpayers with a single, head of household, and qualified widow status, and $32,000 for married taxpayers filing jointly. If you are married and file separately from your spouse, 85% of your Social Security benefits are taxable regardless of any other income. However, if you file separately and have lived apart from your spouse for the entire year, you may consider yourself single when computing your taxable benefits. So how do you compute how much of your benefits are taxable? Here's the formula. Subtract the base amount from 50% of the Social Security benefits plus all other income. The first $9,000, $12,000 if married filing jointly of the remainder is multiplied by 50% and the balance is multiplied by 85%. Those two calculations are added together and compared to 85% of the total Social Security benefits. The lower amount is the taxable portion of the benefits. The formula is structured so that it is highly unlikely for your benefits to be taxable if your benefits are your only source of income. Here are some examples. Jim is retired and receiving $12,800 a year in Social Security benefits. He also collects a small pension of $7,200 a year and has a part-time job paying $3,500 a year. First, we take one-half of Jim's Social Security benefits, which is $6,400. Next, we add in all his other income, which is $10,700. We total the two and get $17,100. Since this is below the base amount of $25,000 for a single person, none of his Social Security benefits are taxable. John and Alice are a married couple filing jointly. John is retired and receives $15,800 a year in Social Security benefits. Alice works full-time and makes $27,000 a year. They receive bank interest on a joint account of $125. First, we divide John's Social Security benefits in half, which yields $7,900. Then we add Alice's wage income and the bank interest, giving a total of $35,025. Since this amount is over the base amount of $32,000, some of John's Social Security is taxable. So let's figure out how much. We take 50% of the difference, since the difference of $3,025 is less than $12,000. We then compare the result of $1,513 with 85% of the total Social Security benefits of $15,800 or $13,430. Since $1,513 is less than $13,430, $1,513 of his benefits are taxable. Here's Kerry. He's single and semi-retired. His income consists of $14,400 in Social Security benefits, a small pension of $4,800, he withdrew $35,000 from his 401k, and he also has a seasonal job that pays $18,000 a year. First, we take his Social Security benefits and divide them in half, equaling $7,200. Next, we add to that all his other income for a total of $65,000. This is definitely over the threshold amount of $25,000, so his Social Security income will be taxable. But how much? First, we subtract the base amount from the $65,000 we calculated earlier, resulting in $40,000. $9,000 is subtracted from this amount, yielding $31,000. $9,000 is then multiplied by 50%, giving $4,500. $31,000 is then multiplied by 85%, which yields $26,350. This is then added to the $4,500, totaling $30,850. This is then compared to 85% of the original Social Security amount, $14,400 times 85% equaling $12,240. Since $12,240 is less than $30,850, $12,240 of Carrie's $14,400 in Social Security benefits is taxable. And believe it or not, that's oversimplified. There are several other factors that go into how much of your Social Security benefits is taxable, but the formula I described applies to the vast majority of Social Security recipients. These calculations are almost never done without a computer. My goal today was to tell you where that computer-generated number comes from. And if you've worked for the railroads, the taxable portion of your Tier 1 retirement benefits is calculated exactly the same way. There are links to resources and worksheets in the description for more information on this topic. Thanks for watching and for hanging in there through this not-so-simple oversimplification. If you have any questions, comments, or suggestions for future videos, please leave them in the comments space below. Again, thanks for watching and stay tuned for more of your taxes oversimplified.